More on Spain, the banks there, the Eurozone debt crisis, and his new book. We are joined now by Simon Johnson, Senior Fellow at the Peterson Institute for International Economics, former Chief Economist at the International Monetary Fund, and co-author of White House Burning, The Founding Fathers, Our National Debt, and Why It Matters to You. Welcome back to the program, Simon. Good to have you with us.
Thanks for having me.
So I want to get to your book, but I have to ask you first of all about what is happening by the hour in Spain, because you know the international banking system clearly from your time at the IMF. Is this essentially a Spanish version of TARP that we are seeing, with Spain putting or buying 45% of this bank?
Yes, it is a recapitalization of one of their biggest lenders. It is an attempt to absorb losses that bank faces on its real estate portfolio. But of course, it's in a very different context from what happened in the United States in 2008, 2009. There is a European-wide crisis. The Eurozone itself is under severe pressure. And Spain's position in the euro is now very much in question.
Spain's position in the euro is now in question. As much in question as Greece's?
Well, Greece is the question of the day, but Spain is the question of the month, because it's very far from clear that the damage that will spread, given recent Greek events, that damage will be contained. And of course, Spain is not the only candidate for a reassessment. Portugal, Italy, and even Ireland are also going to see renewed pressure.
So what about the Santanders and BBVAs in Spain, the two biggest banks, and they are global banks, not just confined to Spain, as you know. What about them? Is it possible that there could be government injections into those banks as well?
Well, those banks are helped by the fact they have substantial operations outside of Europe, particularly in Latin America. However, the scale of the disaster in Spain, and again across the Eurozone, is so large and so much involving all kinds of debt, including government debt, that I doubt any bank will escape unscathed from what is rapidly becoming the biggest economic disaster of modern times.
So is that a yes, that they will have to take government money? The government will buy preferred shares in those banks too?
Well, I think the bigger question, Howard, is whether the government has any money to inject into anyone. What happens to the government credit, this kind of pressure? It's not just a banking crisis, which is what the U.S. had in 2008, 2009. It's also a sovereign debt crisis or a government credit crisis. Then you can't recapitalize banks if the government itself has lost its creditworthiness.
So that brings up the $64,000 question, as it were. Why not let this particular bank, Bankia, fail? Does it have Lehman-like interconnectedness that caused so much mayhem when Lehman was allowed to fail? What's the difference?
Well, it's absolutely about connections of various kinds, and also about expectations regarding how other banks would be treated or protected. But Bankia is clearly too big to fail in the minds of European policymakers. And of course, they have a lot of banks that are too big to fail in the European context. This is very much part of their problem.
And so just one more question on this before we get to your book, Simon. There are 2 million vacant homes in Spain. How do those get sopped up? But we had an earlier guest on who said that in Ireland they're knocking buildings down. Is that potentially what happens in Spain as well? You knock buildings down so you don't have to pay taxes on them and so forth.
Well, eventually vacant properties disappear one way or another. They're not maintained, and they cease to be viable as dwellings. I think, though, before we get there, there will be a more profound disruption of the Eurozone, and countries will leave, or countries will change their exchange rates, perhaps go back onto some version of independent domestic currencies. And in that context, Spain becomes a lot cheaper. If Spanish asset prices were to fall by 20, 40, or 60%, you would find buyers. And that is the usual kind of adjustment mechanism that we have but it's not what can happen with the current structure of the Eurozone.
Okay, well, thank you for your forbearance on those issues of the day. And let's move to your book. As I said, it's called White House Burning, and it deals with debt, in this case, the situation in the United States. And you have written, you and your co-author have written, that our national debt problem will be solved one way or another. What do you mean by that?
Well, either we can take on the debt, bring it under control, and do that in a responsible and measured manner in the United States, or we'll postpone dealing with it, and sooner or later the bond markets will turn against us, interest rates will go up, and we'll have a real fiscal crisis, not exactly the same kind as they have now in Europe, but very much along those lines. When the bond markets don't like you, you're paying a lot more to borrow, you find yourself forced to make a rather hasty and costly fiscal adjustment.
So you foresee the day when there could be a bear attack on U.S. Treasuries?
Look, nobody is exempt from a loss of investor confidence. If you put enough debt out into the market, if you rely as much as the United States does on foreign investors, about half of all Treasury debt is currently held by non-U.S. residents. If you continue down that path, yes, eventually the market will turn against you. When, it's hard to say. That depends on developments in Asia, depends on how long it takes the Europeans to sort themselves out. But sooner or later, if the U.S. doesn't find its way back to a path of fiscal sustainability, then we're going to have trouble.
So when you say it in part depends on developments in Asia, are you really talking about how long it takes before the renminbi becomes a reserve currency?
Well, that's one issue, the rise of China and the power of China with regard to creating its own safe haven asset. But also, and perhaps more likely to matter in the short term, how much do the Chinese save? Very good question, outside the country in particular. Where do they save it? They've actually indicated they're backing away from European government debt, which is good for us in a sense and very bad for the Europeans. But also, does the Chinese economy continue to boom? Because that keeps commodity prices high, keeps oil prices high, and a big part of the savings around the world right now are actually from the Middle East and other oil-rich countries. When oil prices stay high, they save a lot, and they keep a lot of that savings also in U.S. government debt.
You know, you essentially say in the book that tax versus spend, this whole debate that we keep seeing over and over again in the United States in various ways and forms, is really as old as the U.S. You can, trace it back to Jefferson and Adams.
Absolutely, and Alexander Hamilton, who was the first Secretary of the Treasury, who created the model under which the United States could borrow when necessary and bring the debt down when it had the opportunity. That balanced, pragmatic approach to fiscal policy served this country well for 170 or 180 years. But there's no question that we've lost it. And a big part of the book is trying to explain to people in a measured, reasonable way, with a lot of facts and a lot of documentation, exactly when did we take our eye off that ball? When did the United States stop being one of the more careful countries with regard to its budget and rather err towards being somewhat irresponsible, actually consistently and repeatedly irresponsible with regard to controlling our national debt.
And so can you pinpoint a time? I mean, it seems throughout the country's history, debt has risen whenever the country's gone to war.
That's right. There have been 6 big debt surges in American history. The first 5 were almost entirely war. Independence, War of 1812, Civil War, World War I, and World War II. But the 6th surge did have a war component. That's Iraq and Afghanistan. But it also had the big era tax cuts, 2001, 2002. It also had Medicare Part D, an expansion of Medicare coverage to prescription medicine that wasn't paid for. And it had the enormous financial crisis of 2008, 2009 that blew a massive hole in the budget, mostly through lost tax revenue. That's the combination that has brought us to this point with government debt at 73% of GDP, $10 to $11 trillion, and rising fast. That is an essential part of why it's going to be so difficult to turn the budget around.
And so what, before we go to